Hey guys, welcome back to my TFSA portfolio update, where I started off with $2,000 in March 2021, and in 3 years I'm hoping to turn this portfolio into $50,000. Every single week I'm going to be depositing $200 without fail, and dollar cost averaging into my positions, as well as occasionally adding new stocks to the portfolio. Rarely do I plan to sell, but if I do, I'll make that known to you guys in these weekly updates. The purpose of this series is to show you guys that with disciplined investing, dollar cost averaging, you can be able to grow your wealth over time. You're not going to be able to double or triple your money in the span of a couple months like you do with penny stocks. However, I do hope to grow this portfolio faster than the TSX index itself. So I've been measuring my portfolio against the index. Every time that I make a buy, I also record how many units of a TSX ETF I could have bought in and compare my portfolio's performance every single week against that. So if this series interests you, subscribe down below, and I release a video like this every single Monday. And just to let you know a bit more about me, my name is Daniel, and here on this channel, I talk about Canadian stock market investing. I've been investing in the market since 2016 and have seen some high points in the market, as well as also seen huge drops in my portfolio, some as much as 50% like we saw in March 2020. And I've been able to stay invested during the bad times as well as continuing to invest in the good times. So I want to be able to share with the internet just a little bit of things that I've learned along the way. This is not financial advice at all, but just me kind of documenting my journey and hopefully helping out a few people along the way. You shouldn't look at my investments and take them and just do the exact same thing that I'm doing. However, you should be able to look at what I'm doing and try to take some nuggets of information or thought processes behind how I make decisions and apply them to your own investing. And obviously, I'm going to make mistakes myself, and maybe some of the processes that I have or some of the things that I share are not going to suit your personal investing situation at all. So I hope that I can provide a perspective on investing that you can learn from, either from a do this or don't do this perspective. The portfolio that I'm featuring here, I believe, is a fairly decent beginner portfolio. It's a relatively balanced risk where I have about a third of the portfolio in low risk stocks, a third in medium risk stocks, and a third in high risk stocks. The high risk stocks in this portfolio are smaller companies out there that have not had a proven track record of earning any sort of meaningful profits. They are growing their revenues quickly though, so that's why they're high risk, because they could fail and turn your investment of $100, for example, to zero, or could potentially double that investment because they're growing very quickly. Medium risk stocks in this portfolio are companies that are a bit larger, a bit more stable, and have their revenue spread out amongst multiple customers. They may be just cracking profitability or at least cash flow positive, which I've categorized them as a medium risk because they're not going to fail so easily like these high risk stocks, but they're also not low risk because they're not yet paying a dividend out or not able to return capital to shareholders. At the end of the day, as an investor, you're hoping your investments that you make into companies will give you some sort of cash flow or give you a return on investment through appreciation in equity or the stock price. And finally, the low risk stocks in this portfolio are companies that are already paying out a dividend as well as have a fairly good track record of positive earnings. They typically have earnings per share between 5 and 20 and have a proven management team. I believe this portfolio is fairly well suited for anyone between 25 to 40 who doesn't have too much debt outside of real estate. They have a fairly stable job and can afford to invest a certain chunk of money every single month without fail. Also, the person who this portfolio is for as well should have some sort of backup fund just in case they do lose their job and don't need to dip into their investments in order to continue to live. So that's kind of the person that I'm building this portfolio for, which is currently my situation as well. I currently have a good amount of emergency reserve funds. My only debt is in real estate, and I'm saving for retirement in this portfolio. After talking about the thought process behind building this portfolio and my thinking behind all these positions, let's dive right into the portfolio and every single thing that I bought in this past week. At the end of this video, I will also be sharing about what I'm planning to buy next week and giving my reasons for that. Finally, we'll end off with some Q&A, and that should close out for the video. So we're here in my portfolio spreadsheet. The current market value of my portfolio is $3,014.66. On Wealthsimple Trade, it agrees with that. We can see the total estimated yearly dividends at $47.26. And some of you guys with like a $10,000 or $20,000 dividend portfolio, you might be laughing at this, but the whole goal is to build this up over the time. I've collected so far $2.78 of dividends within the span of a month and a half or so. So this is basically like allowance for a 5-year-old, but still, it's nice to have dividends or just money come into this portfolio through dividends. The yield percentage of the portfolio based on this yearly estimated dividends versus the market value is 1.57%. The current value of the portfolio, if I bought the TSX index fund, and the index fund that I'm comparing against is XIC, would have been $3,088.15. So my portfolio performance versus the index, I'm down about $73.49. And as a percentage, it's down about 2.38% compared to if I bought the index. The 1 week change for the TSX this week is negative 1.35%. And the overall change of the TSX since March 16, 2021, when I started this portfolio, was 0.68%. My portfolio percentage change since the beginning was negative 0.88%. So I'm down close to 1% on this portfolio. And every time that I'm down, I'm not going to hide this portfolio away from you guys. I'm going to show you guys every single week what this portfolio is doing, whether it's up or down. Me seeing this negative number is not freaking me out. It's down by 1%, but in the end of the day, I'm holding these stocks that I bought for at least 3 years, and I'm hoping that they will be, a little bit higher than when I actually bought them, or at least enough to get me to $50,000. You can see the percentage of holdings based on all the different stocks that I hold and the percentage of weight that they hold in my portfolio. None of the stocks make up more than 10%. You can see Kinaxis makes up around 10% of my portfolio and the rest are below that. The percentage of my stocks that are dividend versus non-dividend paying stocks, I have 48.2% that pay dividend and the other 51.8% do not pay a dividend. So about half and half. The portfolio risk is 22% allocated to higher risk stocks, 44% to lower risk stocks, and 32.8% to medium risk stocks. I also have a sector weighting, and you can see here that I have a more heavily weighted towards technology, and that's just my personal bias because I do believe that technology will perform better in the long term versus all other sectors. But at the same time, we also have to look at valuation because the technology sector is a little bit more hot right now. So we could say that company is a little bit more overvalued compared to other sectors. Now let's dive into the transactions tab to see what I bought this past week. So you can see here, I'm documenting all my transactions. I also document the number of TSX ETF units that I could have bought versus instead of buying the stock that I actually list here. And then I have a few other columns calculating the cost basis of my positions. So this past week, I bought into 4 different positions. One of them is new and 3 of them are just previous positions that I held, and I was just dollar cost averaging into them. First one was GDMP. I bought for an average price of $1.06. The next stock that I bought was Dollarama, which I mentioned in my previous video that I was looking to buy Dollarama. I got 2 shares at $57.66. If you want to know why I bought Dollarama, check out my previous video and I'll have that in the top right corner as well. I also bought another share of Air Canada, 1 single share at $24.26. And the last stock that I bought was RioCan. I bought 2 shares at $20.16. I bought RioCan more for just dividends. I bought Air Canada as it was dipping fairly heavily, and I do believe that this company will eventually recover, at least in a 3-year time frame, and probably be around $30 per share, if not higher than that. Looking at the chart of Air Canada on Wealthsimple, we can see that currently it's valued somewhere where it was around 2018 or 2019. This is a 5-year chart just for context here. Before the pandemic hit, we can see the stock rose to over $41. I think it was peaking around $60 per share. Today, it's trading at $25.07. I spoke about Air Canada in my previous video as well, so if you want to hear my thoughts about Air Canada, check that video out. Now jumping over to my total portfolio. I'm going to sort a few of these columns and show you just different performance metrics that I track every single week. First one is the 1 week performance. So in 1 week, we can see that the stock that is the largest in my portfolio, Kinaxis, was actually down by 5%. And the next stock that performed the worst was Wellhealth Technologies, which I released a video just yesterday on a short report that caused the stock to drop. Then the best performing stocks this week were Air Canada, which I bought into. Currently it trades at $25.07, and TD Bank as well. So TD Bank rose about 2.3%. Now, if we look based on the percentage of portfolio allocation to see where my positions are, you can see my highest or heaviest positions are Kinaxis, the NASDAQ 100 ETF, Enghouse, TELUS Corp, and then Air Canada. I should also note an interesting thing that I was checking in my portfolio recently was the risk profile and just how the stocks have performed. So if we look at all the high risk stocks, you can see that 2 out of 3 of them are down this week. And they're the biggest losers in my portfolio, Kinaxis and Wellhealth. Looking at the medium risk stocks, a lot of these stocks were, kind of relatively flat, and some of them are down as well, like Enghouse. Looking at the low risk stocks, these ones had the least amount of swing apart from TD. They were all either gained or lost under 1%. So you can see that the lower risk stocks tend to have a lower swing over 1 week versus the higher risk stocks. And the medium risk stocks are somewhere in between. Now, sorting back based on the percentage of the portfolio, I'm going to take a look at my portfolio here and just kind of judge which stocks that I want to buy into. Typically, when I dollar cost average, I tend to look for the positions that have dropped the most, basically looking at the percentage of return column here. The positions that have the largest negative percentage number, I will look at them and weigh if I want to purchase into that stock this week. Because ultimately, I do believe that all these stocks in 3 years from now, barring that there's no crazy event like COVID-19 again in that year, they should be higher than they are today. So looking at Wellhealth Technologies, it currently has about a 4% weighting in my portfolio, and it's down about 12%. I may consider picking up some shares this week, although there's a slight hesitancy because I do own a fair amount of Wellhealth Technologies in my growth stock portfolio, over 1,000 shares to give you a bit more context. Another stock is Good Nature Products, which is down about 8%. And just looking at this, these both are also high risk stocks. So I may only add to one of them this week. I might consider adding it to Wellhealth just to make it a little bit of a higher percentage of this portfolio because Good Nature Products already represents close to 6% of this portfolio. Now looking at other stocks that are down, Air Canada, Enghouse, as well as Kinaxis, I probably will consider adding some Enghouse this week. Enghouse does pay a dividend, so it shows that this company is able to part with some of its cash and not need it for growth of the company, and rather it's rewarding shareholders. And this company is a technology stock as well. So I personally do like technology stocks, and Enghouse is a software technology stock, so they got pretty decent margins as a company. So it being down around 7% from the beginning of this portfolio, I'll probably consider adding 1 share of Enghouse this week. Now looking at some of the smaller positions in my portfolio like Dollarama, I probably will also add another share of Dollarama this week just because it's got a very low weighting and I want to bring this up to at least 5 if not 7% of my portfolio. Dollarama seemed to have pretty exciting plans in the coming years to build more dollar stores. And I believe that, dollar stores are probably not going to be taken over by Amazon because they have very low cost products and Amazon just can't bear to ship $2 products or $1 products to people and earn some sort of profit off of that. So this is where Dollarama has an edge over Amazon in e-commerce, where it sells very cheap goods and it's just not economical for anyone to take this business online at this moment. So now moving on to some user questions. Well, the first one's not exactly a question, but I find it kind of funny and just wanted to address it because I've gotten a few comments about this. So this guy's saying your content is informative and useful, but for blank sakes, man, be more animated. It would be less boring that way. I'm going to be a subscriber for sure because I value your content, but at least try to be less boring. Well, first off, I'll totally agree with you there. I'm pretty boring. As a person, I don't really have that much inflection in my voice and, that's just not a gift that I have. Obviously, I'm trying to work on it, and through this YouTube channel, the goal is to try to learn to have better presentation skills. I don't know how that's been going. I hope that it's been going a lot better, because looking at some of the earlier videos on my channel, they were pretty cringy. But even then, 3 years from now, the hope is to be a lot better than I am right now. So just so you know, I am trying to work on that, and I appreciate your feedback. The second question comes from Southpaw Jinx, and the question is If you're a novice looking to invest your first $500 to $700 into a TFSA, which stocks would you choose? Would you recommend getting stocks with high dividend percentages? And am I better off getting stocks under $10? Or should I buy less shares of more expensive stocks? By the way, I really enjoy watching your videos. Thanks for your great advice. So my personal opinion on this question is that there aren't any stocks that I would recommend you right off the bat without knowing your personal situation. As I mentioned earlier in this video, every person's situation is very different. If you're someone who's in your early 20s, maybe you still have some student debt, I personally would not choose to put the $500 to $700 into a TFSA, but rather I would pay off that debt immediately. And for you to go out there and invest this money instead of paying off your debt, I think would not be a wise choice. But I mentioned earlier on that this portfolio that I'm creating here is for a person who's between 25 to 40 and doesn't have much debt, and they're willing to take some amount of risk. So I think at the end of the day, you should be asking yourself, how much risk are you willing to take? If you aren't willing to lose any of this money at all, then I suggest throwing it into a high savings account. But if you have some tolerance for risk, then consider some low or medium risk positions. And remember my definition for low and medium risk. These are companies that are relatively larger, so look for companies that are above $2 billion market cap or so. That's just sort of an arbitrary number that I'm throwing out there, but if they're above $2 billion, they should be a relatively stable company. Don't just look at market cap though. You also have to look if the company is profitable or not. So look for their P/E ratio. If you want a low and medium risk stock, then look for something between 10 and 30 PE. So those are the sort of the guidelines that I would give you in terms of what to look for when you're investing your first $500 to $700 into low and medium risk stocks. If you're willing to lose it all and you just really want to roll the dice, then buy penny stocks and spread that money if you're buying penny stocks, because you do want to have good risk management. If you throw all your money into one, it could go to the moon, but as well as it could also drop 90%. And for you to gain back a 90% loss, you're talking somewhere around over 1,000% gain. So the goal of investing is to not lose money and make steady income. Addressing your point about would I recommend getting stocks with high dividend percentages, if it's above like 6 or 7%, you really have to question, why is the dividend so high? If the dividend is that high, typically people are selling off that stock because they don't believe in it long term. That dividend may hold up in the short term, but eventually there may be a dividend cut that comes down the road, or the company is on the verge of extinction. I've seen this with my own eyes where companies have like 13% dividend, and I've personally bought into some of these before. But shortly after I bought into them, the company cuts their dividend so it becomes around 5 or 6, or they completely stop paying a dividend altogether, and the stock loses about half its value. An example of this is Just Energy. You can go search them up. And in terms of your last part of your question, am I better off getting stocks under $10, or should I buy less shares of more expensive stocks? Honestly, the price of the stock doesn't really matter too much. I guess if you have $500 to $700, you would want to diversify that money into multiple stocks. So I wouldn't be going out there buying a stock that's worth $300 or $400. However, a stock that's maybe around, up to $30 and you can buy a couple shares of that, that's reasonable in my opinion. That way you can spread out your risk amongst maybe 5 to 10 companies and start to learn good portfolio management. Some people would argue with that and say that you should go all in on 2 or 3 stocks, but as a beginner investor, typically you don't have the conviction to buy into only 2 or 3 stocks and have a fairly good odds of actually making money on that. So that's why I recommend having multiple stocks in your portfolio, maybe somewhere between 5 to 10, so that you can split up your risk. So I hope that answers your question, but maybe that was not the answer you were looking for. You're probably hoping that I'll give you maybe 2 to 3 ticker symbols to start looking at, but at the end of the day, everyone's situation is different. And that's why it's called personal finance. I hope you guys got some value out of this video, and if you did, leave a like down below. If we hit 500 likes in this video, I will release a free version of a portfolio tracker that you guys can use. I've got 2 videos up on the screen right here that I thought would interest you guys. If you're there, I'll see you there. If not, keep up the grind and have a great day.